$1.8 trillion. That's the minimum bet at one specific roulette table. The dealer is wearing a Nasdaq pin. A guy I'll call Stan is doubling his bet. A woman I'll call Pam doesn't know she's at the casino.
Is this for me?
The wheel is rigged. The dealer just changed the rules. This is the SpaceX IPO, and the number changed earlier this week. A few days ago, it was 1.75. In less than 2 weeks, your retirement account is going to be one of the biggest players at this table, whether you like it or not. Because Nasdaq quietly changed one rule, and nobody told you. The only way a nearly $2 trillion valuation makes any sense is if SpaceX is the company everyone thinks it is. It isn't. Ask 10 people on the street what SpaceX sells. Most will say rockets. Some will say Mars. They're both wrong. SpaceX is 3 businesses stacked on top of each other: the good, the bad, and the ugly. The ugly is the slot machine in the corner that nobody plays, except the owner, at a loss. Quick disclaimer, these numbers are so big they're changing while I record this. So if I'm off by a few billion in either direction by the time you watch, forgive me. We're rounding to the nearest 100 billion now, apparently. That's where we are. Let's start there. Elon Musk founded xAI in 2023, the artificial intelligence lab built to compete with OpenAI and Anthropic. It's also mostly known for owning the social media platform X. A few months ago, SpaceX acquired xAI in an all-stock deal that valued the combined entity at $1.25 trillion. With xAI itself accounting for $250 billion of that. If you're wondering how one of Elon's companies is allowed to acquire another one of Elon's companies, the answer is I have no idea. But it happened. The SEC looked at it and said, sure. So you'd assume, with a $250 billion valuation, that xAI is a financially sound company. Or at least that the people who built it still work there. Neither is true. xAI was founded with 11 co-founders, researchers and engineers from DeepMind, OpenAI, Google, Microsoft Research, and the University of Toronto. By March of this year, every single one of them had walked out. Then Elon, on his own social media platform, publicly admitted xAI had to be rebuilt from the foundations up, which is the polite way of saying the CEO of SpaceX just paid $250 billion for an asset that needs to be rebuilt from scratch. How much cash is xAI burning? $3.2 billion in revenue last year, against $6.4 billion in operating losses. That's not a company, that's a furnace. To put that in context, and these numbers move daily, so let's call this a snapshot of one specific week, OpenAI generates about $33 billion in revenue annually, valued at $852 billion. Anthropic generates about $47 billion. And after a $65 billion funding round that closed earlier this week, Anthropic is now valued at $965 billion. Anthropic just leapfrogged OpenAI this week by $113 billion. By the time you watch this, that number is probably different, probably bigger. And SpaceX wants to be priced higher than both of them, combined, on the same exchange that just rewrote its own rulebook to let it in. xAI, meanwhile, does about $3 billion in revenue. It was bought for $250 billion. It's the slot machine the owner plays, at a loss, to himself, burning roughly $500 million a month. A guy I'll call Stan is watching this slot machine right now. Stan owns Tesla calls. Stan has a SpaceX flag. Stan is extremely online.
But sir, this is the future.
It's losing $500 million a month.
BS.
xAI is the reverse Jerome Powell of this casino. Instead of printing cash, it burns whatever cash the other 2 businesses generate. But it's only one of 3 businesses. The other 2 are actually doing the work. Before we get to the cashier's cage, let's spend 45 seconds on the business this whole company is named after. The rocket business. The floor show. Rockets launch satellites for the government, cargo to the International Space Station, crew missions for NASA, and a lot of other satellites, which we'll get to in a minute. The rocket business generated roughly $4 billion in revenue last year, which sounds impressive until you compare it to the nearly $2 trillion valuation. Then it sounds less impressive. Priced like the floor show invented physics. It's still just the floor show.
But sir, the rockets.
They're fine.
BS.
The rocket business is 25% of total revenue, which brings us to the part paying for everything. This is the cashier's cage. Starlink is a satellite internet provider. Every chip on the floor eventually flows through it. Starlink launched in beta in 2020. 6 years later, it's the fastest scaling telecom company in human history. Roughly 10,000 Starlink satellites are in Earth's orbit right now, each one beaming internet down to a little dish that sits on your roof. Pam, the woman from earlier, is using one of those dishes right now. Pam lives 20 miles outside town. Pam does not know how the internet gets to her house. Starlink has grown to over 10 million active subscribers in roughly 150 countries, and in 2025, it brought in $11.4 billion in revenue. That's roughly 61% of SpaceX's total revenue. But the revenue isn't the impressive part. Starlink's profit margins are now 63%, and they've roughly tripled in 2 years. The margins aren't just good, they're accelerating. And Starlink isn't just for consumer internet. There's a maritime version that ships and yachts use, an aviation version commercial airlines have started rolling out, and a classified defense version called Starshield with contracts at the National Reconnaissance Office and the Pentagon. So this is the real SpaceX, a cashier's cage that prints cash, a floor show that's fine, and a slot machine lighting $500 million a month on fire. 2 of these are paying for the third. In 2025, Starlink and the rocket business brought in roughly $8 billion in profits, which sounds great until you remember xAI showed up to ruin the party. The consolidated company, including xAI, ended up losing nearly $5 billion on roughly $18.5 billion in revenue. So back to the question from the start, who is buying SpaceX at a $1.8 trillion valuation? Right, you. This isn't about rockets. It isn't about magic satellites in space. It's about the casino quietly changing the rules at the table, right before the biggest bet in market history. On May 1st of this year, Nasdaq adopted something called the Fast Entry Rule. With SpaceX pricing on June 11th and listing on June 12th, under the ticker SPCX, the timing is convenient. Let's talk about how Nasdaq rolled out the red carpet. The Nasdaq 100 is the gold standard for technology and growth companies. It's not just a badge of honor to be included in it. Dozens of ETFs and structured products with nearly $600 billion in assets track the index, which means once you're in, every fund that follows the index is forced to buy your stock, automatically. Billions of dollars of capital, whether they want to or not. Now, Nasdaq, for the record, did put out a press release explaining the rule changes. In corporate speak, the changes were necessary to, quote, better reflect the evolving landscape of capital markets and the growing prevalence of innovative listing structures. Translated, we've made it easier for big new things to show up to the table. The press release does not mention SpaceX. It also does not mention OpenAI, Anthropic, or any other private company currently considering a public listing, which is convenient, because the new rules, by sheer coincidence, happen to fit companies that look exactly like those. A 4% float, a 9-figure last private round, a capital structure where the founder still owns most of the company, a sponsor structure where the largest pre-IPO investors are also the largest post-IPO shareholders, all of which, 6 months ago, would have disqualified you from the index. Now, it just makes you eligible. So here's what the new rules actually do. Under the old rules, a newly listed company had to wait at least 3 months before being added to the Nasdaq 100. That waiting period existed for a reason. It gave the market time to discover the actual price before passive funds were forced to buy in. The new fast entry rule cuts that waiting period from 3 months to 15 trading days. 3 months of price discovery compressed into 3 weeks. Convenient. But that isn't even the change that matters most. There used to be a minimum free float requirement to join the Nasdaq 100. A company needed at least 10% of its shares actually available for the public to buy and sell. SpaceX is targeting a free float of 4 to 5%. Under the old rules, they wouldn't qualify. Under the new rules, the minimum is gone. SpaceX suddenly qualifies. And then there's the new hidden multiplier. This one is the hardest to wrap your head around. Buried in the methodology is a multiplier. For companies with a free float under 20%, Nasdaq now treats the float as 3 times bigger than it actually is. A 4% float gets weighted as if it were 12. A 5% float gets weighted as if it were 15. The multiplier caps once your float hits 33%, but if your float is small enough, you get the full triple credit. Every chip on the table now counts as 3. There aren't more chips. The dealer just decided your chip stacks weigh more, because the dealer says so.
But sir, the multiplier.
I know.
BS?
Here's what all of this means together. Nasdaq bent the listing requirement, so SpaceX can join the index with just 5% of the company actually trading publicly. A float level that would have been an automatic disqualification 6 months ago. Nasdaq changed the price discovery timeline, so SpaceX skips the 3-month seasoning and gets dropped into the index 15 trading days after going public. And Nasdaq changed the weighting rule, so ETFs are legally required to treat SpaceX's float as if it were 3 times larger than it is. That's manufactured demand. That's the house edge. So has the casino done this before? The same trick, different table. 2012, Facebook IPO. $16 billion raised, at the time the largest tech IPO in history. Nasdaq's actual systems broke on opening day. From the volume, the exchange paid a $10 million fine to the SEC, the largest penalty ever paid by an American stock exchange. Every ETF tracking the Nasdaq 100 was forced to buy Facebook at the opening price. 3 months later, when the first insider lockup expired, the stock had dropped roughly 50% from the IPO price. Every fund that was forced to buy it at the opening ate that 50%. What's different this time? Just one thing. In 2012, Nasdaq didn't rewrite the rules to engineer the demand, they just rode the wave. This time, they're holding the wave open. With a sand timer they get to flip, and chip stacks they get to weigh. And it isn't just SpaceX. OpenAI and Anthropic are both reportedly eyeing public listings within the next 12 months. Both will almost certainly list with the same configuration the new rules were tailored for. Nasdaq didn't rewrite the rules for one company, they rewrote them for a class of companies. SpaceX just got the first table. So that's the rule change. Nasdaq cleared the way to the table. The question now is, who actually gets the chairs? Most IPOs allocate historically about 10% of the offering to retail investors. SpaceX is targeting 30%. Brett Johnson, the CFO of SpaceX, told a room of bankers on the record that retail will be a critical part of the IPO, bigger than any IPO in history. In his words,
retail is going to be a critical part of this, and a bigger part than any IPO in history. Those are folks that have been incredibly supportive of us and of Elon for a long time, and we want to make sure that we recognize that.
Translated from corporate speak, the CFO of SpaceX just told a room of bankers that the largest IPO in history is going to dump 30% of its supply on retail buyers. Not because retail helps with price stability, not because retail helps with long-term shareholder alignment, because they're loyal to Elon. So here's how this story plays out. The buyers and sellers don't show up at the same time. The buyers are forced in early. The sellers get unlocked later. Chips move from insiders sitting on a low-cost basis to passive funds and retail accounts that absorb them at peak valuation. Stan is at the table because he wants to be. Pam is at the table because the pit boss escorted her there without explaining why. Both end up with the same chips. The portfolio manager George Noble, formerly of Fidelity, 40 years on Wall Street, said it best.
Your 401k is literally the exit liquidity.
Here's what that means in real numbers. If you have $100,000 in your retirement account, somewhere between $300 and $600 of it is going to be SpaceX within 90 days of the listing, without anyone asking you. $1.8 trillion, the number from the start of this video. In casino terms, it's the chip stack the house cashes out into. And right now, your retirement account is the one feeding the cage.
But sir, the table is up.
I know.
BS.
Yes. Here's why this isn't the headline. SpaceX to IPO at nearly $2 trillion. That's a headline. Nasdaq quietly rewrote its float weighting methodology to engineer passive demand for an unprofitable company. That doesn't roll off the tongue quite the same way. Passive investing was sold to you as the smart way. Low fees, diversification, set it and forget it. All of that is true, but the same mechanism that buys the index for you automatically also bets your chips on whatever new table the house opens, without your input, without anyone asking. The feature that makes passive investing easy is the same feature that makes you a guaranteed buyer for anyone who can get a chair at the table. And right now, somebody just walked up to the table and asked the dealer for a chair. Less than 2 weeks from now, June 12th, ticker SPCX, you're already buying. Want to know how much? Open your retirement account this week. Find the Nasdaq 100 ETF in it. See what's about to land in your portfolio. You'll have your answer. Then drop it in the comments. The bigger the number, the more interesting the conversation.